Thank you. Good morning. First, I'd like to thank Chairman Powell and Vice Chairman Quarles for holding the conference and for inviting me to participate, and importantly, for understanding and acting on the need not only for transparency with the public, but for going outside the usual suspects and including alternate views and even dissenting voices. As Chairman Powell recently said, disagreement is not only healthy, but important. Before turning to the paper, for those of you who have asked, and many of you have, who's Better Markets? Better Markets was founded just after the Dodd-Frank law in 2010. It's a nonprofit, independent, DC-based organization that promotes the public interest throughout the economic and financial policymaking process in Washington. We've participated in more than 200 rulemakings, many of the related lawsuits, testified in Congress numerous times, and issued lots of reports. Lots of information on our website if you really want to know more. Turning to the topic of the panel, I'm going to offer some quick observations on policy related to the issues raised by Andrew and Greg and their thoughtful and thought-provoking paper that I encourage you to read. Because there's too much to say in too little time, if you want to know more about Better Markets' views on the details of stress tests and the Fed-specific proposals, again, they're on our website at www.bettermarkets.com. You'll find lots of information, and where I also hope to be posting more detailed thoughts on the paper in the conference in the coming days. My first observation relates to what is at stake. The only thing standing between a failing bank and a taxpayer bailout and an economic and human catastrophe is loss-absorbing capital, period, full stop. That is really what we're talking about when we're talking about stress tests. The last crash is going to cost the United States more than $20 trillion in lost GDP, which Better Markets did a study on called the cost of the crisis and the cost of the crash. Those dollars don't reflect the human suffering all across this country as tens of millions of Americans lost their jobs, homes, health care, and so much more. If stress tests fail and banks don't have sufficient loss-absorbing capital, then the public is again going to suffer the consequences and get the bill for that failure. And they should have a seat at the table, and their interests should be the center of any discussion, which I will return to at the end of my remarks. A second observation would be don't snatch defeat from the jaws of victory. U.S. stress tests are the gold standard. Stress tests have worked exceptionally well. You don't need to be told that they have been used at one of the most perilous times in our country since the Great Depression of the 1930s. That real-time live stress test of stress tests restored the confidence of the financial system and the public. And then remember, the opposite happened in Europe. They, too, at that time, employed stress tests. Virtually all the banks passed, but the tests weren't considered rigorous, lacked transparency, and left substantial capital holes. And thus, Europe's stress tests lack credibility. That's the risk here, losing credibility. And that leads to my third observation. I'd suggest that stress tests be thought of primarily as credibility tests for the Fed. That credibility has already taken some hits. Some are already referring to them as well on the way to being no-stress stress tests. Others have observed that stress tests have gone from confidence builders to mere capital ejection mechanisms. Some have noted that what was originally thought of as a process to create a capital floor has created a capital ceiling. We should ask if a test where 100% of the test takers pass every time with flying colors is a valid, credible test. Such results are usually a red flag. We need to ask if it is wise that a bank failing the stress test should be avoided at all costs. Entire new words and processes are being developed and deployed to avoid even saying the word fail. When Goldman Sachs and Morgan Stanley failed the test by falling under the capital requirements last year, the Fed didn't fail them. Rather, it invented a euphemism, quote, conditional non-objection, close quote. We need to think about how these actions, changes, and mindsets are fundamentally challenging the credibility of the tests and, yes, the credibility of the Fed. I'll turn to my paper with my fourth observation. As you've heard, Andrew and Greg have suggested an analytic framework organized around the concepts of peacetime and wartime regulation. While theoretically interesting, the likelihood of correctly knowing when it is peacetime is impossible, and being wrong, even by a little bit, will be dangerous, if not catastrophic. We don't have to speculate about that. We have definitive proof. Let's take a minute to speak honestly and openly about the years before the 2008 crash. We had failures of judgment of historic proportion by policymakers, elected officials, and by regulators, including prominently the Federal Reserve Board, its staff, and its many affiliates like the New York Fed. They were mostly wrong, dead wrong, with grave consequences. A tragic groupthink blinded most to growing risks and the coming catastrophe. We're not talking about ancient history like the 1990s. Think back to the celebration of the Greenspan years at the 2005 Jackson Hole Conference. Even the mildest indirect academic dissent was not just greeted with disagreement, but disdain, ridicule, and name-calling. Peacetime reigned. No need to even question the prevailing, dare I say, wisdom. It was peacetime. Everybody agrees. Markets know best. The least regulation was best. The biggest financial institutions in the world could self-regulate and self-police. None of them would ever take outside risks that might endanger the viability of their firms or reputations for brilliance, sophistication, and risk management. Now, none of that is to cast aspersions. Those are just the facts. They are facts that no one saw coming, even the brightest of the bright. The unavoidable conclusion is that we all must be deeply humble about our ability to determine when a crisis is coming, or frankly, even when we're in the middle of one. That means that artificial constructs of peacetime and wartime and the false comfort the former instills should be rejected as unworkable and should not be a guide for policy, and certainly not policy deregulation because it's supposedly peacetime. For example, in the years before the 2008 crash, exactly when did we move from peacetime to wartime? When subprime loans or synthetic CDOs reached a certain level? When the Bear Stearns hedge funds collapsed in 2007? When they shopped their books earlier in 2007? When Goldman flipped to the Big Short? When Northern Rock failed? To ask these questions is to reveal that they aren't answerable even in hindsight, and certainly not in the middle of peacetime, going to wartime, maybe wartime. However, I would suggest that when it comes to financial regulation, you are always at war, which is my next observation. Policymakers in general and regulators in particular should accept that conflict in financial regulation is inevitable, healthy, and indeed a sign of success. The paper says that stress test exercise, quote, remains a more or less contentious process, close quote, which the authors attribute to, quote, bankers bristling at the perceived loss of control over basic capital planning decisions, close quote. And they note that it is important that there will always be conflict here, quote, but largely limit that to, quote, the speed of capital adjustment after a stress test, close quote. That limitation is too limited. Regulators and bankers are always and inevitably at war, even if they don't always feel it. That's because it's not a hot war, but a steady-state Cold War. You have financial institutions pressing the limits at all times as they profit, if not bonus maximize. We have to stop pretending that we agree on the financial reform goals and mostly on the ways to achieve them. Ending too big to fail and workable resolution plans are prime examples. Effective stress tests and sufficient loss-absorbing capital are others. Regulators and bankers bring and should bring different perspectives to these issues, which lead to different views and inevitably disagreement. And that's why the authors noted that the, quote, banks have said thank you, close quote, for greater transparency provided by the Fed, but the banks have nonetheless, quote, asked for even more, close quote. Of course they did. That's their job. It is in direct conflict with the job of the regulators. That will inevitably result in tension and disagreement, and frankly, that's a good sign. I want to make a related observation. It is most important to understand that evil actors in or evil motives by the private sector are not required for any of these observations or concerns. It is the nature of markets and financial firms individually and ultimately collectively. It is the siren songs of profit maximization and competitive pressures. As Upton Sinclair said so well, quote, it's difficult to get a man to understand something when his salary depends upon his not understanding it, close quote. That's why banking regulators and supervisors, as well as oversight, regulation, and enforcement generally, are so critically important and will always have conflict. A concluding observation. The concluding section of the paper entitled, quote, balancing the cost and benefits for banks and regulators, close quote, raises some very serious concerns. It begins with a troubling question that frames the discussion of the entire section. Quote, have we struck the right balance between the needs of banks and their regulators, parenthetically, and taxpayers, in the stress test policy, close quote. Taxpayers are only mentioned in the parenthetical, never to appear again. Bankers' needs and wants, in contrast, are very prominent, to the point that the conclusion is, quote, a bank's board should have more power over capital planning in peacetime, while regulators should be able to intervene as war approaches, close quote. In addition to rejecting the peacetime-wartime framework, I would suggest that focusing on balancing the so-called needs of banks and regulators turns the world upside down. Taxpayers and their needs should be the center of the question, analysis, and answer. I would propose asking the question, do stress tests serve their purpose in protecting the public, taxpayers, the financial system, and our economy from undercapitalized, over-leveraged, too-big-to-fail banks that pocket profits and bonuses in peacetime and shift losses to taxpayers in Main Street in wartime? And let's look at the evidence. Banks had to be bailed out in 2008 by taxpayers because they didn't have the capital to absorb their own losses. Why was that? Because those banks spent down their capital on stock buybacks and dividends in the years before the 2008 crash. And indeed, think about this, up to and after the collapse of Lehman on September 15th. That's right, after the collapse of Lehman on September 15th, they were still ejecting capital. The banks intentionally and needlessly reduced their capital cushions even as the crisis was upon them, even as they were taking big losses starting in 2007, even as Bear Stearns collapsed, even as Lehman crashed. The regulators said nothing and did nothing. All the clearly ominous events and warning signs of 2007 didn't slow the capital ejections. In closing, as I said I would at the start, taxpayers must be central to the entire discussion and above the, quote, needs of banks, close quotes. And I reiterate the question that should frame policymaking. Do stress tests serve their purpose in protecting the public, taxpayers, the financial system, and our economy from undercapitalized, over-leveraged, too-big-to-fail banks that pocket profits and bonuses at all times and shift losses to taxpayers in Main Street in a crisis? That is what is at stake in stress tests and loss absorbing capital. Thank you.